Everyone. Welcome to today's presentation. Today we have an exciting topic for you, taking a deep dive into Roth Catch-up regulations. And I have Craig Hoffman here. He is our attorney and senior consultant here at NOVA. So we should be enjoying a next fun hour on this topic. Before I turn it over to Craig, just a couple of housekeeping items. First, like to make sure to point out the question box that should be in your upper right-hand screen. That's where you'll enter any questions you have throughout the presentation. We will hold the Q&As until the end of the session if we have time. Do feel free to enter them in. If time runs out and your question wasn't answered, we will be preparing to send out the answers to you. Also, feel free to email us at webinars@nova401k, and we'll make sure to get your question answered. Beside the questions, you will also see a paper icon with a little paper clip. That is where the handouts are. You can find today's materials in PDF form. If you're here with us to earn CE credits, be sure to stay until the end, fill out the pop-up survey that will allow us to track your participation, and certificates will be sent out within a week. With that, I will turn it over to Craig and take us away, Craig.
Well, thank you, Kim. Good afternoon, one and all. Let me wish you a belated happy Thanksgiving and Merry Christmas, Happy Hanukkah, and a very happy holiday season. Welcome to, I'm not sure I'd call it exciting, but a worthy topic that we are all having to deal with as we get ready for the onslaught of Roth Catch-up contributions. This is titled A Deep Dive. The idea is I want to focus on what we learned from the final regulations, which came out, I guess, about a month and a half ago, as we get ready for the final stretch to implement these new rules. The normal disclaimer, this is general discussion. It's not meant as individual legal advice. If you need legal advice, consult your own attorney or CPA if you need tax advice. CPA credit, that this is for, I think, Texas CPAs, but again, if there's any question on your credits for CPA or otherwise, contact us at novawebinars.com. That's me. I've been doing this for 40 years. I've been lucky. Actually, it's almost 45. It'll be 45 coming up shortly. But I've been very happy and thankful to have the opportunity to continue working with my good friends at Nova. Karen Smith and the team have been good friends of mine for many years, and it's been a pleasure to be part of the team now. And keeps me busy, and as I phase my retirement, I'm still working hard. Now, normally at this point, I would insert a picture of my dog. If you've been on my webinars in the past, you know how one of the loves of my life, besides my wife and daughter, is my dog. And she turned 4 yesterday, and she's right behind me. But instead, I'll just briefly show you what I did on my summer vacation. Yes, somehow my wife talked me into going on an African safari to South Africa, and that is a picture I took. I've got a million more, but that's just representative. And this is our little happy group, my wife, my son-in-law, my daughter. It was quite the experience. If you have any interest in going on a safari, I'm happy to give you the benefit of what we learned. It's a long flight to South Africa, but it was worth it. So on a better note, let's move forward to the topic du jour, catch-up contributions. And primarily, we're going to be talking about Roth, but briefly touch upon the super catch-up contributions, which were also part of Secure 2.0. So super catch-up was added by Secure 2.0. It provides a higher catch-up limit for certain individuals of a certain age, 150% of the normal limit. It applies to K plans, 403B, and 457B government plans. And a plan is not required to include it, but if you decide to include the higher limit, it's got to be uniform across all plans sponsored within the control group. And the magic age for super catch-up is you must be at least 60 during the taxable year and no older than 63. So once you turn 64, you're too close to retirement. You don't need any super catch-ups. The real reason they limited it is it would have cost too much money in foregone tax revenue. So this was the compromise they came up with. So it was effective last year, still, or this year, I should say, and still time to take advantage of it. We just recently got the numbers for both this year and next year on what the limits are and will be. Nothing new really in the current limits. So you can see the super catch-up amount is 11,250 versus 7,500, resulting in an extra $3,750. Next year, we just got the numbers. If you've been under a rock and didn't hear, the regular limit's going up by 1,000 and the regular catch-up by 500. The super catch-up, however, is not rising in 2026 due to a quirk in the language in the Secure Act. The first COLA increase will, if there is enough COLA, which there should be enough inflation, it will rise for 2027. But for 2026, you see the numbers. 32.5 is the max for a catch-up eligible regular person. Super catch-up eligible gets 35,750. So good to have. Not a lot, but better than a stick in the eye, as my dear father used to say. So that takes us to the real topic du jour, the final Roth catch-up regulations. As again, the idea is we're going to focus really on what was in the final regs, but as a very brief summary of the catch-up rules, a catch-up contribution is an elective deferral that exceeds a limit that would otherwise preclude the catch-up eligible person from making that deferral. The limits, the one we're most familiar with is the 402G limit, that 24.5 limit for next year. It's also called the 401A30 limit. The A30 limit's the plan requirement. The 402G is the individual limit. I use 402G throughout to describe that limit. The other limits you might have is the maximum contribution limit under 415, the ADP limit for 401k tested plans that could result otherwise in distribution of deferrals, and then finally a plan limit. Clearly, without question, the most common application of catch-up contributions is for exceeding the normal 402G limit. Now, that's a catch-up contribution. It should be distinguished. It's an age-based catch-up contribution, if you will. 403B plans and 457B government plans have special catch-up provisions that are service-related. And those service-related catch-up contributions are not subject to the Roth mandate. So what we're talking about are these age-based types of catch-up contributions that exceed a limit. Now, a deferral is just a deferral. It only becomes classified officially as a catch-up contribution when it exceeds an applicable limit. And the timing of that varies. With respect to the 402G limit, that occurs at whatever point in the year that the aggregate deferrals exceed that normal 402G limit. So it can happen really at any time during a year, whereas The other limits are not determined until usually after the plan year or limitation year is over. The good example is the ADP limit. You don't know what it is until the year is over and you do your 401k testing. So then and only then does a deferral become classified as a catch-up, which can be problematic when we're dealing with the Roth mandate, in that you don't know when the deferral is going in what it will ultimately turn out to be necessarily. And that's why we'll see as we go through it, there are vehicles to correct errors that are made because of things such as that. Now, as part of the catch-up general rules, all participants in the plan must be eligible to make the maximum catch-up contribution. And a second element we'll talk about a little later is the ability to make catch-up contributions is a benefit, right, or feature under the non-discrimination regs, and so must be available on a basis that does not favor the highly compensated employees. So under Secure 2.0, the change which took effect in tax year 2024 is that certain highly paid participants, if they want to make catch-up contributions, they must be made as designated Roth contributions. Now, although the new law was effective in 24, the IRS came up with an innovative idea for an administrative transition period under which the new law, at your option, Mr. Plan Sponsor, can be applied for 24 and 25, but that's at your option. Beginning in 26, you must apply the new law. I don't know of any plan that elected to apply the new law in 24 and 25. So for the vast majority of people, the administrative transition period meant we can wait till 26. Now, one last point before we move on. I refer to these people subject to the Roth mandate as highly paid participants. But there's no magic definition within the code where these people are just defined by their characteristics. So commentators, people talking, making presentations on the subject have various acronyms and names for these people. I use high paid participants. Others use highly paid individuals. I've also seen highly paid employees, high FICA wage earners, to name just a few. But just so we're clear, when I use the acronym HPP, it's referring to the people subject to the Roth mandate. And who are these? Well, whoops, I got a little ahead of myself. So why did we get that transition period? Because we didn't have any guidance from the IRS. The first guidance we got were proposed regs in January of 25, a year after the new law was already in effect. And we just got final regs a couple months ago. So that guidance will shape how we comply in the year ahead. The final regulations, however, do not apply until tax years beginning after December 31, 2026. And that delay in the applicability date for the final regs confused a lot of people who thought it was another extension of the transition rule where you didn't have to do anything, and that's not true. What it means is you need to comply with the new law beginning next year, but you can do so using a good faith, reasonable interpretation of the statute, which might differ in some respects from the final regs. Beginning in 27, you've got to follow the final regs. There is no waffling. So the important point to be made, and frankly, as far as what is a reasonable good faith interpretation, you can't go wrong if you follow the final regs. So I think most people, their in compliance process intends to follow the final regs. but we'll talk a couple places where there may be room for a little wiggle room as we figure this all out. Government and collectively bargained plans have a little bit longer till the final regs apply. They don't have any longer to when the law applies. And to be clear, again, the administrative transition period was not extended except in one very limited circumstance for certain multi-employer plans, collectively bargained plans with multiple employers entering into a bargaining agreement to provide retirement benefits pursuant to good faith bargaining. So vast majority of our plans, there's no getting around it. The time to comply is 26. So the initial step then is determining who are these HPPs. And the law said it's somebody who received wages in the prior year that exceeded 145,000. That's what the law said. But as I mentioned, the law was effective in 24 and 25. We've since got some inflation such that we just recently had announced, notice 2025-67, that the limit that we will be using against 25 wages to determine who is an HPP in 26 has bumped up to $150,000. So that's what we're saying here. An HPP is one catch-up eligible person who in 25 had wages, that's another element, from the employer sponsoring the plan that exceeded 150,000. Two open issues really: what wages do we use, and who is the employer sponsoring the plan? Well, the final regs confirm what was in the proposed regs, that the wages we use are Social Security FICA wages. Those are the wages that go into determining a person's ultimate Social Security benefit. They are what is reported in box 3 of your form, of the employee's form W-2. And the preamble confirmed you can just go to box 3 and that's your number for looking back to determine who is an HPP. Though the why they did this, I don't know. They had comments of people who wanted to use box 5, which are FICA wages for purposes of the Medicare portion of Social Security taxes. And only in very limited circumstances are there any differences. But some people had asked, can you use that? The IRS said no. But if that really floats your boat, that would be a good faith, reasonable interpretation to apply in applying the law in 26, if you really wanted to do that. I don't know really any. I guess some people have a reason for doing that, because there are some items that are not in Medicare wages that are in Social Security. We could spend a whole day talking about that element of definitional element. All right, moving on. So it's FICA wages in box 3. The threshold does not need to be prorated. So if you're hired mid-year but don't go above the 150, you're not an HPP in the next year. An example being Colin, hired in November at a salary of $240 a year, 240,000. So for November and December of 25, Colin received 40,000 in FICA wages. So he's a high-paid person, but he's not a high-paid participant subject to the Roth mandate in 2026, because he only received 40K in wages in 2025. Assuming he stays with the company and makes 240,000 in 26, he'll be an HPP then in 27. The final regs also confirmed, which there was some comments on this in the proposed regs, but it's clear, if you do not have any wages that are subject to Social Security FICA taxes, then you will never be an HPP. And the prime examples of people who do not have FICA taxes subject to Social Security are sole proprietors and partners in partnerships that are taxed as unincorporated entities. They receive self-employment income. Self-employment income has a separate tax that goes into the Social Security calculations, but it's not FICA. So they partners and sole proprietors who receive only self-employment income are not subject to the Roth mandate. Same is true for certain government workers where their employer has elected out of the Social Security system. I've gotten questions since then. Well, what about Subchapter S shareholders? They get pass-through income like partners. Yes, they do, but it is not self-employment income. It's basically dividends, if you will, that are taxed through. And owners who work who tried to take basically a $10 income for a business that generated $1 million in earnings. So in any case, sole proprietors and partners are the primary example, not Subchapter S owners with pass-through income. The other element, as I mentioned, is it's wages from the employer sponsoring the plan. And Secure 2.0 didn't really define what that meant. The IRS in the proposed regs interpreted that to mean the employer to whom you give common law, perform common law services, the person who hires and fires you. They, incidentally, are the person responsible for the employer's portion of Social Security wages. So that means if I work during the year for two different employers, the plan, the only wages relevant for the plan that I'm participating in is from the employer who sponsored that plan. Even though I may work for a related company part of the year, those wages are not considered as being paid from the employer who sponsored the plan. And this is true as well in the multiple employer or PEP plans. You know, there are a number of participating employers. Typically, I may work for more than one of them. They may be related, but I only look at the wages I receive from that employer for whom I perform common law services. Now, with that said, that has provoked some concerns because there are, particularly in larger businesses, some complicated payroll processes under which the entity for whom you perform services is not necessarily the one paying your pay. And the IRS carved out 3 exceptions where you can, if you wish to, it's optional, if you wish to, you can aggregate wages for more than one employer. The first example is controlled or affiliated service groups. If you work for 2 members of the same affiliated service group, the employer at its option can choose to aggregate compensation to determine if you're over the 150,000 threshold. Let me, I should have said this first, preface by saying, I'm not sure anybody would really want to do this. Because by definition, if you're aggregating wages, you're taking more wages into account, making it more likely that somebody may be characterized as an HPP, which I think in most cases you want to avoid the mandate, let them decide on their own. But so in any case, I'm not sure how popular this will be. If you want to aggregate for members of a controlled service group where you have employees working for more than one, it's got to be in the plan document. And you've got to specify whether it applies to all members or only certain members. And if only certain members, you've got to specify which members. Okay, so I'm not sure how popular that will be. The second may be more, again, in larger corporation entities. There are rules under the payroll tax regulations that allow one company to be designated as the common paymaster for certain other related entities. That common paymaster is then responsible for preparing and filing W-2s on behalf of all of the companies using their service. They're using them as the common paymaster. It's not really a service. They're part of the group. It's not a service provider, if you will. So under the final regs, if you want to determine HPP status, you can aggregate the wages paid by everybody using the same common paymaster. And again, if you choose to do that, you need to specify whether it's everybody or only certain entities using the common paymaster. Now here, this may make sense because, you know, a company with multiple entities, subsidiaries, a complicated corporate structure may find the idea of trying to break out compensation to determine this more administratively challenging than worrying about who's subject to the rule. And so bottom line, I can see this as being perhaps something that may be attractive. And then lastly, it's not uncommon for a business to be sold by virtue of selling all of its assets to a buyer, and the employees who used to work or who work for the selling company transfer and become employees of the buyer. There are tax reasons why asset sales make a lot of sense, but they're two unrelated entities. But under IRS rules, it is permissible for the buyer and the seller, but for the buyer to agree to take over responsibility for the W-2 reporting of employees who are transferred as part of the asset sale. Again, if you want to do that, that's fine. You just need to put it in your document and appropriately denominate who are the HPPs once you aggregate this compensation. But as I said, it's really only attractive if administratively it's difficult to trace the wages for more than one employer that an employee works for during the year. And again, the election needs to be in the plan document. You can operationally provide for it beginning next year, but ultimately when you amend your plan for secure, you will need to incorporate that operational election into the plan terms. Moving on, plan design concerns. Well, I don't know if this is a concern as much as something to watch out for or take advantage of. And that is there's nothing to preclude a participant who's catch-up eligible from designating the elective deferrals they make from day one as Roth contributions. Nothing wrong with that. That's their election. And many people these days are putting everything in Roth based upon some of the talking head advice. But the idea is, however, that those contributions are not catch-up contributions until they exceed a limit. And it's possible that at the time a person does in fact exceed the 24/5 limit, they will have already made Roth contributions during the year such that their catch-up contributions do not have to be made as Roth. They only need to be made as Roth to the extent an HPP has not already used up their pre-tax deferral limit, the 24/5. And so you need to account for that. An example is Fergus. Fergus is an HPP, age 55. We're in 2026. And through the end of October, he had contributed 24.5. It all works well that way. And for anybody who noticed, Fergus, my little dog Fergie, who's laying right behind me anyhow, her name comes from Fergus, who was a character in the Outlander book series and Starz TV series. So Fergus is here, Fergie's here in name, if not in picture. Anyhow, Fergus put away 24.5, but he put 10K of Roth in already. So by the time he gets to November and December, what goes in are catch-up contributions, but they do not need to be Roth. And so the plan, we'll talk about it. The plan can apply the deem Roth election there, but when you're applying it at a time when the person has not used up their full pre-tax limit, it can be administratively challenging because of the requirement to give a person the opportunity to elect something different than the deem Roth election. And we're going to talk about that in a few moments. So we'll come back to the deemed election discussion. In fact, here it is. I forgot it's next. So normally a participant must make an affirmative irrevocable election at the time they decide to make a deferral to treat it as a after-tax Roth. So the only way you can get Roth is if the person designates it. Well, to accommodate some of the messiness of this new law, the final regulations, as the proposed did, allow a plan to include language under which a person is deemed to have made the Roth election in order to fulfill the Roth mandate with regard to catch-up contributions. And most plans will want to include the deemed election. I think the vast majority will, though I've heard some countervailing arguments. In my mind, I think you're better off, and we'll discuss it as we go through this. But the main reason you want the deemed Roth is the condition precedent to being able to use some new correction options that were added by the final regs. The most common application of the deemed Roth election will be in the context of spillover catch-up contributions. Claire, again, as I'm making my life easy from a math standpoint, she's contributing $24.50 a month on a pre-tax basis. At the end of October, her total deferrals equal $24.5. The deferrals contributed in November and December are now catch-up, and the plan language can deem them automatically to be Roth, even though Claire has not so designated them as Roth. However, the plan, the participant must be given a so-called effective opportunity to make a different election. Well, in Claire's case, the only election she can make, if she's already made 24.5 in pre-tax catch-up, then her only election is to cease making catch-up contributions if she doesn't want Roth. But that's not always the case, and so let's talk about circumstances where it's not always the case. Well, under the final regs, the deemed Roth election can be applied either when a person's pre-tax deferrals equal 24.5, the limit, or alternatively, you can start deeming amounts to be Roth at the time the total deferrals, irrespective of whether they're Roth or pre-tax, exceed the 402G limit. Now, in my opinion, you don't want to do that. But apparently, some payroll providers who lobbied for this do not have the capability of tracking deferrals separately for pre-tax versus Roth. They only know when the total deferrals equal 24.5, they're now catch-up. And so that presents problems, because if you start deeming the deferrals based upon, irrespective of whether the pre-tax 24/5 limit has been reached, but rather just total deferrals are at 24/5, then you're back to having to give the participant an effective opportunity to make a different election. And now, because the participant has already made some, has by definition, has made some Roth deferrals, if we're aggregating both, then you're going to have to give that participant the opportunity to make a pre-tax election as part of that effective opportunity. And that type of administrative hassle does not arise when the deemed election only takes effect at the time the pre-tax deferrals individually exceed the 402G limit. So the key issue is, what can the plan sponsor's payroll provider give them? And this is going to be an integral part of figuring this whole thing out, is how it is all going to work between the plan sponsor's payroll provider, the record keeper, and the plan sponsor. And so if you have not already, now is the time to having these discussions with those providers as to how they are going to move forward. And I can tell you, it's late, but many record keepers and payroll providers are still trying to figure it out. So I'm not sure you would have gotten very good answers a month ago, and certainly not 2 months ago before the regs came out, final regs came out. The deemed election can also be applied to separate election catch-up contributions. And this is, I'm at a loss for words. It just chokes me up so much. It's silly, in my opinion, but people want to do this. And plans let them do it. I want to make $1,000 in regular contributions and $500 in catch-up contributions out of each paycheck. Well, that's fine. You can call it that, but it's not a catch-up contribution until it exceeds the limit. So whatever you call it, it's not officially a catch-up until it exceeds the 402G limit. And applying the deemed Roth election to catch-up contributions that you know are not catch-up is just asking for, in my opinion, more administrative complexity. And an example, Jamie, age 54, elects to contribute an HPP, again, is putting 2,000, the famous 2450, but he has designated them as 2,000 regular and 450 in catch-up. And if Jamie stays to the end of the year, it'll all work out swimmingly. He'll end up with, well, actually, some of it will be catch-up. In any case, as of 10/31, Jamie has 24/5 of total deferrals. The designated 20,000 as catch-up, and 20 as regular and 4,500 as catch-up. But because he's only contributed 24/5, none of it is catch-up. If he terminates employment on October 31 and makes no further contributions, and that's, I got a little ahead of myself. So at the time, 10/31, we don't have a catch-up contribution because nothing's exceeded the 402G limit, and you only have a catch-up when it exceeds the limit. If he quits on October 31 and doesn't contribute, none of that money is catch-up money, subject to the Roth mandate. You can deem it to be Roth, but we're back to now having to give Jamie the effective opportunity to elect pre-tax. And that's going to almost invariably require a correction, which can be avoided by not allowing for this separate catch-up contribution election that's not really a separate election per se. It doesn't officially designate it as a catch-up. So as we said, you've got to have an effective opportunity. The final regs, as the proposed, say it's facts and circumstances based on the adequacy of notice, the availability of the election, and the period of time during which the election can be made. The IRS didn't provide any further clarification, although they were asked to do so. They said it was beyond the scope of the Roth regs. So in the absence of any further guidance, I think clearly telling people what they need to do if they want to make a different election than the Roth election, designated Roth on catch-up, and how they should go about it. If they get notice, I would recommend including it in the normal annual notice and enrollment materials included in the SBD, and tell them, hey, if you don't make a different election, we're going to make it Roth. Now, some have suggested that it's enough after giving this notice that you simply, if the participant haven't been told, you can change it at any time, and that's how you can get out of the Roth. That's all you need to do. That's the effective opportunity. I'm not sure I disagree with that. The good folks at Spark, which is the Record Keeper Trade Association, put out a best practices document in September that essentially says they feel this way. And I think this may, we need to see how this all plays out over the year ahead, but I would hope the IRS will see the best efforts in this regard as within the reasonable interpretation of the statute. You can't ignore it. There's got to be some attention paid to it. The question is how much when it's a facts and circumstances test. As I said, the most cases of a person has filled up their pre-tax bucket at 24.5, the only election available is make no further contributions. If they don't want Roth, they're an HPP, they're shut off. But again, under some circumstances, the HPP may have to be given the opportunity to still elect pre-tax. One being where the person voluntarily elected Roth. We already mentioned that. The deemed Roth election being applied to a participant to participant separate election designated catch-up contributions that turn out not really to be catch-up contributions. And again, the same thing can happen. You can have a pre-tax election still available if you start your deemed Roth election at the time total deferrals exceed the 402G limit rather than basing it individually on pre-tax deferrals exceeding the 402G limit. So that's, again, why I'm a big advocate of applying the deemed election on that basis. It is optional. You don't have to use the deemed Roth election. If you do so, you'll lose out on the ability for the correction methods. If you use the deemed Roth election, it's certainly possible that a person may no longer be subject to the Roth mandate. From year to year, they make less comp than the threshold calls for, or they may get a amended Form W-2. In either case, the deemed election needs to cease within a reasonable period of time following the date on which the person is no longer subject to the mandate or an amended W-2 is filed. And I'm not sure quite honestly how to interpret as a throwaway line in the final regs, amounts deemed to be Roth contributions before the end of this reasonable period do not need to be recharacterized as pre-tax. I'm not sure how that is consistent with the use of the deemed. You must have a reasonable opportunity to make a different election. I assume they are implying you had that reasonable opportunity, didn't take advantage of it, and now we can keep them as Roth contributions as long as we cut it off the deeming within a reasonable period of time after the person is no longer subject to the mandate. As I said, some plans are not going to use the deemed election. They're going to require participants to make a designated Roth election. If they don't make a designated Roth election, then they're going to be zeroed out. No further catch-up contributions. But again, I'm not sure. It might be easier administratively, but you may not have happy HPPs who want to catch up and save as much as they can for retirement, irrespective of its pre-tax or Roth. I think if people are trying to catch up and make extra catch-up contributions, more likely than not, they're happy to take it. If they're forced in the Roth, so be it. So I think most people would prefer to be deemed into Roth rather than zeroed out. But again, this is a question for your own particular plan sponsor, record keeper, and payroll provider. Must plans add Roth? The answer is no. But if you don't add Roth, then you can have a disconnect in discrimination testing because of a disconnect between the HCE definition and the HPP definition. You can have highly compensated employees who are not HPPs. The prime example being partners in a partnership lawyers in a law partnership making $1 million a year in self-employment income are not HPPs, but they're HCEs. And if you've got a 2-lawyer partnership and you've got high-paid associates making more than a 150 who are HPPs but non-Hileys, you can have a discrimination problem. So most plans are adding Roth. If you really don't want to add Roth, a new safe harbor was added in the final regs that say if you exclude HCEs who receive self-employment income over the threshold, even though it's not FICA wages, if you exclude them from catch-up contributions, then you don't have a discrimination feature. Again, not sure how many people are going to want to use it. Final regs reaffirm you can have Roth only. The Roth rules require you have a choice between pre-tax and Roth, and mandating Roth for catch-up takes away that choice. Correction. The final regs added 2 new minor exceptions where if you've made an error in allocating a Roth catch-up to a pre-tax account, you don't have to fix it. One is de minimis failures, where the principal amount of what was misallocated is $250 or less. The second is if the error occurred because of a late determination of FICA wages, which is not made until after the deadline for correction, which is generally by the end of the following year. I don't see that as often coming up much, so it's great to have them. But generally speaking, if you do not move that errantly allocated Roth from the pre-tax, you're going to disqualify your plan. So it's got to be corrected. And the easiest correction method in the final regs is the W-2, where you simply transfer the incorrectly allocated deferrals along with allocable gain or loss. You move it from the pre-tax account to the Roth. And when you issue the W-2 for the year, the W-2 simply correctly reflects that as an after-tax Roth contribution. Easy peasy. That would be the best way to do it in all cases. However, it is only available until the time the Form W-2 for the year is either furnished to the participant or filed with the government, which at the latest will be January 31, but a lot of employers furnish them sooner than that, and that would be the deadline. So many times, as we've seen, you're not knowing whether it's even a catch-up contribution until the year is over. And so you're not going to be able to catch it within the January 31 W-2 deadline. So W-2 is out. It will work, though, for certain errors you find during the year. You can move it easy peasy, this would be the best way to go. In the absence of being able to use the W-2, the in-plan Roth rollover correction method is your go-to. Under this method, it's treated much the same as a voluntary in-plan Roth rollover a participant chooses to make. You simply move the errantly allocated deferrals, including earnings or loss, from the pre-tax to the Roth account, and then you issue a 1099-R showing it as a Roth conversion includable in income in the year of the correction of the transfer. And it's, again, treated generally the same way as an in-plan Roth conversion from a taxation standpoint. Now, the proposed regulations had confusing rules about when you needed to, the deadline for correction. The final regs simplified things by saying, well, one, you don't have to use the same method for every limit, the type of limit exceeded. You must use the same correction method for all participants similarly situated. And so we're talking W-2 in-plan Roth. Well, which one are we going to use? Well, I think it's pretty easy to use W-2 for folks that you catch before the W-2 deadline, and in-plan Roth rollover for everybody else. Easy peasy. The one thing you can't delineate the similar situated participants on the basis of investment returns. And I haven't quite figured out what abuse that's stemming. But in most cases, the prerequisite to using this, to making corrections, is the plan must have practices and procedures designed to result in compliance with Roth at the time the deferral is made. And those procedures must include the deemed Roth election. So that's, if you don't have the practices and procedures that include the deemed Roth, you're not using W-2, you're not using in-plan Roth rollover. So that's why the deemed Roth election, in my mind, is a no-brainer to go with. What's not clear is how these procedures specific to Roth catch-up contribution requirements are any different than the general procedures a plan must have to qualify for self-correction under EPCRs. I think the beefing up those procedures, having something in place would be helpful. We'll see how the IRS views this, how strictly they apply that in the context of audits. The deadline to correct, the proposed regs had a confusing set of deadlines. The final regs give you one deadline. It's extended. You've got to make the correction no later than the end of the plan or tax year following the year in which the deferral was made. The tax year is what we use for 402G because it's based on the tax year. The rest are on the plan year or limitation year. But so you have until the end, you make a mistake in 26, you have until 27 to fix it. However, until you fix it, the improperly allocated contribution will not be treated as a catch-up, which the IRS throws out, which could lead to negative tax consequences. What the heck is that? Well, for example, if a person, that's not even, don't even think about catch-up, got some guy or gal who made 24/5 of deferrals and then makes another $1,000 contribution. They've exceeded the 402G limit. How do we fix that? If it happens by mistake, well, we make a corrective distribution by April 15th of the year following the year in which the deferrals were made. By doing that, the participant reflects those deferrals in their income tax, and they're just one time, the year they exceeded the limit. On the other hand, if the violation is not corrected until after April 15th, then as of that date, the elective deferrals exceed the 402G limit, which means as of that date, the excess, the $1,000 excess in my example, is going to be taxed, and it'll be double taxed when you correct it by either distribution or conversion or rollover to Roth. So that won't make a participant very happy. And so the deadline, for that reason, if you're dealing with 402G, you want to fix it by April 15th of the year following the year in which the deferral was made. For ADP test recharacterization, you want to fix it within 2.5 months or 6 months for an IACA to avoid the 10% excise tax on corrective distributions. But keep in mind, if you end up correcting the ADP failure by making a QNet, you never have a recharacterization, and there's no Roth catch-up violation in that circumstance. 415 limit, there really isn't, or plan limit, any additional consequence for correction beyond and up to the year following the year in which it was made. If you miss that 1 year deadline, then you've got to follow EPCRS. This outlines where in EPCRS, basically you've got to distribute. And questions have been raised, is there any way you can just fix it using EPCRS self-correction without having to distribute? And that's a good question, one which people are discussing. The IRS hasn't given us any answer. I think we must look to the new iteration of EPCRS that's been due out for a couple of years now. We're dealing with the 2021 iteration. They normally come out every 2 years. It's on the guidance, IRS priority guidance plan. So we'll see if there's an answer there. And lastly, just a quick, generally when you start your Roth account, you have a 5-year window, after which that distributions can qualify for favorable treatment. But when you do a conversion, you have a new 5-year window waiting period on each individual conversion event. And we questioned whether that was going to be true for these corrections as well. And the IRS answer is yes. So if you're under, it really only impacts if you're under 59 and a half, where you've got to wait 5 years after the rollover conversion correction to avoid a potential recapture of the 10% early distribution tax on the taxable portion paid out. Well, that was a lot. I got 55 minutes on my clock. We might have a little time for a couple of questions. Do we have any, Kim?
There are a couple of questions. The first one is kind of from the beginning of the presentation, but the question is, will plans that allow leave buyback, meaning contributing unused leave as deferrals, also fall under the regulations we are discussing?
Yes. I mean, the bottom line, this goes back, I want to say 20 years, when there was an article in the Wall Street Journal about how this magic idea that you can contribute unused vacation pay to your 401k account as some magic new idea. Basically, what you're saying is you're getting your vacation pay as compensation, and if you defer 100% of it, it's a deferral. It applies against your 402G limit, and yes, to the extent you end up, those amounts are over the 402G limit and are treated as catch-up for an HPP, they would have to be Roth amounts.
Okay, great. And one more question and we'll wrap it up. So do local municipalities such as police, fire department, etc., 457 plans fall under governmental plans that have additional time before complying?
No. Governmental plans have additional time for applying the final regulations but they do not have additional time for applying the mandate. The mandate's effective in 26. Governmental plans have until, I think it's 120 days after the close of the legislative session that has authority to amend the plan, I think it is. But until then, that government plan still has to comply. It's just the final regs. They can use a reasonable good faith interpretation longer, is the gist of it. The only exception to actual compliance for a very small period of time are multi-employer collectively bargained plans under 414F. Well, I got 3 o'clock, which means it might be 2 o'clock where you are, 1 o'clock, might even be noon. Those on the West Coast, it's lunchtime. For me, as many of you know, Fergie is my love, so we're heading out to the dog park for the rest of the afternoon. Again, I hope everybody has a very happy holiday season. And look forward in the new year. I'm sure we'll have some new and exciting webinars from our Nova family. Thank you very much. Kim, close us out.
Thanks so much, Craig. Yeah, so if you're looking for the handouts on the slides, they are attached to this platform. If you look in your upper right-hand corner, there's a little paper and paperclip icon, and feel free to download that. If you can't find that or need further slides sent to you, feel free to email us at webinars@nova401k. To view any webinars you have missed, and the recording of this session will be available shortly on our YouTube channel, which is Nova 401k Associates. So again, thanks so much, Craig, for today's presentation, and thanks everyone for joining. Have a great day.
Bye, everybody.
Bye.